For the foreign investor tempted by Chinese property, there's much to mull over. 3 or 4 years ago, there was a lot of bullishness on the prospects, and it looked like we were seeing a boom with plenty of upside. It didn't take long, though, before murmurings about bubbles began. That prompted intervention from Beijing, and we saw pretty severe restrictions put in place to cool things off.
The government has sworn that it's going to keep the tightening measures in place. Property developers are slowly getting back into the business, though. Banks have cut off flows of financing to them, but they've been able to access financing from other sources, primarily from trust firms and from the corporate bond market.
Despite government efforts to dissuade investors then, it looks like some won't be kept away. And it's not hard to understand why. They see demographics on their side. China's all-important middle class is expanding and urbanizing.
Looked at from a macro perspective, it's clear that China does need to build lots more homes in the coming 2 decades as the population continues to urbanize. The problem really is that the homes that have been built to date don't really fit what the population actually needs. Too many high-end homes, too many villas, luxury homes have been built. What's really needed is a lot more low-end, basic, affordable property. Now, the government has made a big push recently to speed up the development of affordable housing, of social housing, and it's beginning to gain some traction in those efforts.
No doubt, bulls in the Chinese property shop will take yet more confidence from the recent housing data. Alphaville's Kate McKenzie says that at least one analyst sees real estate investment as the biggest story in the country's November data. Meanwhile, FT reporters Simon Rabinovich and Josh Noble on the ground in Beijing and Hong Kong say they're seeing investor enthusiasm for debt and equities linked to Chinese real estate, as well as in the properties themselves. It's worth remembering, though, that not all real estate is created equal.
Comparatively, the larger cities' assets, especially in the core areas, are of much better investment value than smaller cities. Because of the pre-sales system in China, the cash flow situation is very different for selling houses versus setting up the office buildings and the shopping malls. So because of that, the oversupply situation in the housing side is actually more, I would say, visible than offices and retail. So from that perspective, I think if you want me to rank, in terms of in general, the different types of assets, I would rank housing as the worst in general, and then probably followed by offices. Actually, I'm pretty relatively bullish on retail.
If after weighing all that up, you're still a willing investor, there's a question of whether you're able. According to Credit Suisse, the restrictions have been loosened. It's no longer difficult for foreign buyers to purchase residential property, but that may not remain the case.
The restrictions still exist on paper, and I'm pretty sure that the Chinese government's policy is actually taking a kind of like a tweaking along the way. So what they do is that if they see the housing prices keep going up, like what they did in July and August, they will probably come down harder on the implementation of those policies. So the government is actually using those policies as a way to send signals to the market in order to control the housing prices.
So as Kate McKenzie points out, once investors have calculated whether the China property story is a tale of bubble-priced assets or much-needed housing, all that's left to do is predict which way the government will move. Well, here's an assessment from UBS. They expect the government to keep in place purchase restrictions and that the credit stance will remain neutral. That will probably put a cap on the upside of this rebound.